As we speak, the U.S. banking sector is experiencing a severe downturn as a result of a domino effect of bank failures and the vulnerability of other banks. This unsettling development has far-reaching implications for the global banking industry, leaving many to ponder whether this is a mere coincidence or a replay of the painful 2008 financial crisis. Now, to get a clearer picture of the current situation, we must take a step back and examine the events that led to this crisis. It all began on March 8 when Silvergate Bank, which had a strong focus on the cryptocurrency sector, declared that it was ceasing its operations owing to significant losses in its loan portfolio. This abrupt turn of events was attributed mainly to the collapse of FTX, the world's second-largest cryptocurrency exchange, which was one of the bank's biggest clients. Then in the following few days, on March 10, the worst banking failure in the United States since the 2008 financial crisis occurred when Silicon Valley Bank, a significant lender to the technology industry, was hit by a classic bank run. The institution was located in Santa Clara, California, which is considered the heart of the country's technology region. It was the most prominent bank in Silicon Valley based on local deposits and one of the largest in the nation, and served as a primary source of venture capital, which is a type of private equity financing for startups. The bank had supported many early-stage tech companies with substantial growth potential, and nearly half of all U.S. venture-backed technology and healthcare businesses relied on SVB for funding. Although largely unknown beyond the Silicon Valley area, the bank was one of the top 20 commercial banks in the country, with total assets of $209 billion as of the end of last year, according to the FDIC. The collapse of Silicon Valley Bank resulted from a typical bank run. However, to comprehend why a large bank with a vast customer base like SVB was susceptible to such a situation, we need to examine the state of the U.S. economy over the past few years. Despite the bank's downfall happening within just 48 hours, the underlying reasons go back years, involving the Federal Reserve's actions and the bank's investment choices. Back in 2020, the world was hit hard by the COVID-19 pandemic, disrupting regular business and daily life, and putting the U.S. and global economies on a precarious edge. Governments worldwide had to take drastic measures to save the global economy from collapsing. To counter the economic repercussions of the pandemic, the U.S. Federal Reserve and other governments worldwide took several steps to pump money into the economy and avoid a severe recession. The Federal Reserve cut interest rates to almost zero, bought massive quantities of government bonds, and implemented different lending facilities to support the financial system and provide liquidity to households and businesses. Moreover, the U.S. government has passed various stimulus bills, which include direct payments to individuals, increased unemployment benefits, and financial aid to businesses. The impact of the low interest rates and massive injection of money into the economy was significant, leading to an age of easy money. At this time, SVB saw a surge in customer deposits, resulting in an unprecedented level of liquidity. In order to make more profit, the bank, like many others, bought long-dated and seemingly low-risk treasuries and bonds, which paid more interest rates at the time. However, this decision had consequences, as the low interest rates and excessive liquidity fueled demand for goods and services, leading to unprecedented high levels of inflation, which has become a growing concern for the U.S. Fed and other central banks. Despite initial expectations of inflation being transitory and moderate, the actual inflation rates have exceeded expectations. As inflation rates continue to soar beyond the expectations of the Federal Reserve, aggressive measures were taken to counter its effects. The Fed decided to lift interest rates at an unprecedented pace, along with other central banks across the globe, in an attempt to cool down the global economy and curb inflation. However, these rate hikes had a detrimental effect on Silicon Valley Bank in two key ways. Firstly, the tech industry, which was one of the main customers of SVB, suffered the brunt of the higher borrowing costs. Secondly, the rate hikes undermined the value of the Treasury bonds, which banks including SVB had invested in just a few years ago. The value of these bonds plummeted as the money got tighter, resulting in unrealized losses worth $620 billion for America's banks. As reported by the FDIC, the high interest rates that the Fed implemented hit the tech sector hard, where SVB's clients primarily operated. The elevated rates made it difficult for tech companies to raise funds, and they began withdrawing their deposits from SVB. However, SVB's funds were tied up in securities like treasuries and bonds that were losing value due to the high interest rate. To meet customer demands for their money, SVB had to sell off these securities at a loss, turning the unrealized losses into realized losses. This forced SVB to sell its $21 billion bond portfolio at a $1.8 billion loss. And on March 8, the bank CEO Greg Becker announced that the bank had sold substantially all of its securities portfolio, and as expected, the announcement caused panic in Wall Street and the U.S. financial industry. Following the sell-off off by SVB, the bank needed to raise more capital. But the announcement of SVB's need to raise money had an adverse effect on its customers, many of whom were tech startups. The news triggered a panic, resulting in the withdrawal of $42 billion from the bank in a single day, leaving it with a negative cash balance of $1 billion. As a result, the parent company, SVB Financial's stock price dropped more than 60% within 48 hours, causing a ripple effect on other banks. Several bank stocks, including First Republic, PacWest Bancorp, and Signature Bank, were also temporarily halted on Friday. The situation was so dire that SVB had to abandon its efforts to raise capital or find a buyer. In response to the imminent collapse of Silicon Valley Bank, U.S. regulators took swift action by immediately closing and taking over the bank. The California Department of Financial Protection and Innovation appointed the Federal Deposit Insurance Corporation, FDIC, as the receiver and created the Deposit Insurance National Bank of Santa Clara, DINB, to protect insured depositors. The FDIC promptly transferred all insured deposits of SVB to the DINB to ensure customer protection. As a result, California regulators closed down the tech lender and placed it under the control of the U.S. Federal Deposit Insurance Corporation. The FDIC, acting as a receiver, will liquidate the bank's assets to pay back its customers, including depositors and creditors. Following the collapse of Silicon Valley Bank, other major banks began to feel the ripple effects of the crisis. Signature Bank, a New York-based bank with $110 billion in assets and $8 billion in equity, was the next to experience trouble as customers panicked and began withdrawing their deposits. On March 12, the New York State Department of Financial Services closed the bank since it had shown no signs of improving its finances. As the situation worsened, First Republic Bank, a full-service bank and wealth management company, saw its shares drop over 20% on March 15th. However, thanks to the intervention of major U.S. banking giants such as Bank of America, Citigroup, JP Morgan Chase, Wells Fargo, Goldman Sachs, and Morgan Stanley, who poured $30 billion in deposits, First Republic Bank was able to avoid collapse. When a crisis strikes, it's human nature to look for someone to blame. And as SVB collapsed, the focus immediately turned to the leadership positions within the institution. Analysts were quick to point fingers at ineffective management, corrupt practices, and the inability of executives to anticipate the potential impact of the crypto market's turmoil the previous year. In fact, it was later revealed that SVB Financial Group's Chief Executive Officer Gregory Becker, Chief Financial Officer Daniel Beck, and Chief Marketing Officer Michelle Draper had sold $4.5 million worth of shares in the bank's parent company. Some argue that they may have seen the collapse coming and should be held accountable. Some people may also point fingers at the Federal Reserve for its role in the crisis. The Fed's monetary tightening in the previous year resulted in 7 interest rate increases, totaling 425 points, followed by another 25 basis points hike. This move brought the target range for the federal funds rate to 4.5% to 4.75%, the highest it had been since October 2007. Economists argue that the Fed may have raised interest rates too quickly and by too much, which may have led to a shortage of money supply, making it difficult for new investments to occur, especially in the technology sector. Despite the similarities to the 2008 financial crisis, the U.S. government had to take action to restore confidence in the banking system. The Biden administration guaranteed the customers of Silicon Valley Bank, which had failed, would have access to all their money. The U.S. government guaranteed the deposits to avoid 2 potential risky scenarios from the bank's failure, both of which could have dire consequences. Firstly, other banks, with similar profiles to SVB and Signature, could be next to fail if customers lose faith in their ability to fund deposits. Secondly, tech companies that kept their cash with SVB could collapse if they were unable to make payroll or fund their operations. In another related action, the government shut down Signature Bank, a regional bank that was on the brink of collapse. Signature's customers will receive a similar deal, ensuring that even uninsured deposits will be returned to them. The Fed will also make additional funding available for eligible financial institutions to prevent runs on similar banks in the future. The Fed's new bank term funding program is designed to prevent the next SVB from collapsing. These actions were taken to shore up confidence, make sure banks can still make loans, and pay out to customers who want to take their money out. Last week's collapse of Silicon Valley Bank sparked concerns about the stability of other weaker lenders, including Credit Suisse, which has been facing problems for decades. As the second largest lender in Switzerland and a global systemically important bank, Credit Suisse's issues have the potential to impact the entire financial system. However, unlike the factors that contributed to SVB SVB's collapse, the problems at Credit Suisse are more complex and multifaceted, with vulnerabilities lurking in the financial system. While interest rate hikes have played a role, there are other underlying issues at play. Now, Credit Suisse has been facing challenges for years, struggling with missteps and compliance failures that led to numerous management overhauls and billions in losses. The bank has been hit with fines and penalties for tax evasion and misplaced bets, among other issues. However, its recent collapse of U.S. hedge fund Archegos Capital, which cost Credit Suisse $5.5 billion, was fatal. In addition, social media speculation that the bank was on the brink of collapse led to billions of dollars being withdrawn by customers, making profitability almost impossible for the bank. Despite receiving a $50 billion emergency lifeline from the Swiss National Bank, Credit Suisse found itself in a sudden downward spiral last week, causing its customers to shift their funds to other banks. Credit Suisse initially received an emergency loan from Switzerland's central bank, which temporarily soothed the market. However, it became evident by the weekend that Credit Suisse needed to be saved. To prevent a major bank collapse that could trigger wider fallout, Switzerland's largest bank, UBS, purchased Credit Suisse for almost $3.25 billion in a below-market purchase supported by the government. The deal includes an insurance scheme from Swiss agencies to backstop potential losses that UBS faces from taking on some of Credit Suisse's riskier assets. The truth is, Credit Suisse, once a banking giant, has been dealt a significant blow by its own actions in government, which has forced it to accept a takeover bid from its biggest rival, UBS, that values the bank at less than half its market capitalization. This represents a tremendous fall from grace since the 2008 financial crisis. UBS, on the other hand, is well equipped to absorb some of Credit Suisse's losses from the takeover, thanks to support from the Swiss government and the Swiss National Bank. In response to the current stressed market conditions, several global financial institutions, including the Federal Reserve, the European Central Bank, the Bank of England, the Bank of Canada, and the Bank of Japan, have announced fresh measures to ensure there is enough funding available. Although there are significant differences between SVB and Credit Suisse in terms of size, assets, clients, and location, both banks have lost the confidence of their customers and investors, leading to a liquidity problem. While the collapse of Silicon Valley Bank initially caused panic on Wall Street and led to a sharp decline in its shares, experts suggest that its failure is not likely to trigger a chain reaction like the one that occurred during the 2008 financial crisis. However, the impact may be more severe for smaller banks that are heavily dependent on industries that are facing financial strain, such as the tech and crypto sectors. As a result, these regional and smaller banks may experience a bumpy ride in the near future. In summary, the challenges faced by SVB and Credit Suisse are indicative of a broader issue within the banking industry. The industry is grappling with a large number of low-yielding assets that have been hit hard by the recent rate increases. While identifying new areas of vulnerability can be difficult in the complex world of banking, the emergency support from regulators and governments has so far prevented any significant contagion within the sector. For now, it appears that the chances of turmoil spreading across other firms and sectors have been contained. Let me know in the comment section below what you think will be the immediate and long-term effect of this crisis. We hope this video has provided you with a better understanding of the root causes and consequences of the U.S. and global banking crisis. As we have seen, the impacts of financial crisis can be far-reaching and long-lasting. By learning from the past, we can better prepare for the future and make informed decisions about our finances. Thanks for watching, and be sure to like the video and subscribe to our channel for even more valuable and informative content like this.